Today we got what is hotter than expected inflation data, yet we got the counter reaction that we typically get to inflation in the market. And it's more coinciding with what we've been saying is the true effect of inflation on stocks. The stock market has been saying that inflation is going to cause stocks to sell off, but I've been of the belief that this is not the case and that inflation is actually very bullish for stocks. So typically what we've seen when we've had inflation scares is a market sell-off, and that has to do with bond yields. So we see inflation rise, bond yields rise, and rising bond yields causing stocks to fall. Today we saw a very different reaction, and we have to see if it's going to stay because it's very early. It's just interesting why this is happening now and didn't happen the previous times we were talking about inflation. Today we saw very hot inflation data, 5% year on year from May. Yet we saw bond yields fall, stocks rise, and particularly growth stocks rise. And nothing too crazy happening with energy. That might have to do with Iran. We'll get to that kind of stuff in a second. But, nothing crazy is happening. The market is not reacting to this. Part of that might be the fact that the market expected inflation. Inflationary data is no longer a surprise, it seems. It's definitely not to me. It's definitely not to anybody else, I think. So I guess we can say that some inflation is certainly expected, at least in the transitory sense. We really got to let time go by to see if it's going to be structural. But for now, it seems like we all can agree that it's here, and it's not a surprise to anybody. So it's going to keep occurring. If you ask me, we're going to keep getting data about this. But ultimately, what it means is the economy is relatively strong. This wouldn't necessarily be happening if there were, spending fears, if people were truly tightening the belt. There's a massive increase in household wealth. That has a lot to do with the stock market, has a lot to do with the real estate market, has a lot to do with just general household savings as well. Stimulus checks, people saving money, not wasting it as much on things here. So it's a pretty good economic environment. So it's not like we're getting inflation and we're having a terrible, situation. It's like we're getting inflation and it's a pretty good environment and it's not, causing any problems yet. So I think the move here is to remain long stocks because if there is inflation, I believe it's going to increase cash flows. Yes, it's going to increase input costs, but this is what I was saying several months ago when we were first starting to talk about this. We've already been seeing, the full effects, structural effects of inflation in certain markets, and we can take cues and extrapolate that to other markets. If you look at the housing market, several of the largest input costs are up. Pretty much all of them are up. The price of land is up. Lumbar is certainly up. Copper, certainly up. Price of labor, certainly up. So, all the input costs are up. The final sales price of the goods, so home prices, is up. Yet demand is hotter than ever. I think we can extrapolate that given the rise in household wealth, the relatively strong economic environment, to the rest of the economy. And we shouldn't be fearful yet of inflation. Not fearful. I have no reason to be fearful, at least from the perspective of stocks. For the person who's got all bonds and doesn't work and won't have their income adjusted, yeah, that would probably be a concern for that person. But we are here buying stocks. And if you look at the 1920s and 30s Weimar Republic, the people who did best in that environment were the capital owners. We are putting our capital to work in stocks. We are the capital owners by owning stocks, particularly farm stocks in that environment. But the economy has broadened now. It's a much more advanced and larger economy than it was in the 1920s and 30s. So what was farms one day is now chips, semiconductors, Apple, other technology, cars in today's environment. So I think we're going to be all right. We just got to keep our stocks and we'll see what happens. Maybe the market is going to start embracing inflation, and inflation is going to be good for stocks, as I believe it ultimately will be, despite the fears we've had and despite any sort of short-term bond yield rhetoric we might get. What matters is real yields, and those are increasingly negative. Increasingly negative. The bond yield situation right now is better than it was when bond yields were like 0.6%. So, until next time, peace out.